Dow component. So that's two to watch here as the markets start the day a little bit to the downside.
Our next guest says even though the equity market continues to climb that wall of worry, she's not yet ready to give up on her yield supporting strategy. Joining us is Diana Avigdor, VP and Head of Trading at Barometer Capital. Diana, great to see you again. That's a phrase we haven't heard quite some time, the wall of worry. But the equity market is actually doing a pretty good job of scaling it.
Sure is. There's more and more data points that are sort of not supportive, and yet the market continues to be risk on, as we call it. Even this morning with futures down 4, you know, we've had IMF say that China growth could be at 4.25% if global growth slows, and we know that global growth could slow, and the futures are not down that much. German industrial production was very negative, down 2.9%. Flat was expected. You know, when we were more worried about the markets, these kind of data points would have given us an opening of at least 10 futures points. But the market is compliant. The VIX is below 20. So despite the fact that the market is climbing these walls of worry, these negative data points lead us to want to stay in our conservative stock picking, yield supportive type of strategy. And with rates being this low and Mr. Bernanke coming out and saying that rates will stay low, maybe even a year or two longer than originally expected, the yield enhancing strategies should work even at times of risk on and risk off, of course. So we'd like to stay conservative at this point.
When I look at the performance for the first, I guess it's 5 weeks now, of activity in Toronto, where you usually find those dividend names, telecom, consumer staples, I'm looking at Toronto utilities, they have certainly underperformed. Have they underperformed enough, and have the others gone high enough to want to maybe do the switch again or not?
So they have underperformed, but they have generally been okay. So you know, let me give you an example, and then this is extreme, and this is in the U.S. But Sears Holdings, for example, last year was down 58%. This year so far it's up 55%. We have these binary trades going on where whatever didn't work last year is working this year, and vice versa. But as market will normalize, you know, the headline risk out of Europe and the economic data that's coming out is still supportive of a more conservative investment strategy. And I think that there is a generational shift going on. There are people in the stock market that have been in the stock market that have had their risk tolerance reassessed, that will want the yield enhancing. Like, for example, $9.2 billion of corporate bond issuance has been issued in Canada. That has really been soaked up, no problem. We have the Bank of Nova Scotia deal, AltaGas block trade last week, really has had quite a lot of appetite. So I think that those strategies will work going forward.
And Diana, I guess you've noticed that not a whole lot of hedge fund activity in the market right now. What does that tell you? What kind of signal does that send?
You know, the headline risk is equal to the upside as it is to the downside, and I think those hedge funds are having a hard time deciding which way to go. On the plain vanilla side, of course, in the new year, you could put your chips on the table and see how it plays out, so there was a little more activity. But you notice volume is down. So not only hedge fund activity is down, but also high-frequency trading has been seen down. VIX below 20 is very low, so, and we also have some non-supportive data that are on their own showing bullishness, like the short interest on the triple Qs, which are the NASDAQ ETFs, haven't seen this low since 2009. Should something crack in the market, there would not be that much buying support there. The same is happening when you look at the CFTC data, when you look at long interest in oil contracts, and again, those NASDAQ being at a pretty decent high here. So, you know, the sentiment and the positioning is such that should something crack in the market, there would not be that much support. And Francis, you look sometimes at the City Economic Surprise Index, that has been a little sloppy. And that has led some people to talk about the last Friday's payroll number as being a coincidental, maybe even a lagging indicator. Now, that being said, I'm not saying it was an excellent number, and it's good to see the reparation going on, but participation rates are at low 60s. So we're working through these numbers, and while I'm not discounting that the market is working on repairing itself, but these are the reasons we'd like to stay in conservative yielding strategies.
I actually have to thank you for that Citigroup Surprise Index, Diana. It's actually a very useful thing to take a look at, to just get a gauge. So just net, it's kind of steady as you go in terms of what you want to do here. You're not really in a position to want to get really aggressive or on the offense at the moment.
That's right. And you know, the correlations, I remember we spoke about equity correlations. All stocks were trading the same way. All stocks were up together, down together. That's equity correlations, means they're all going together. Those correlations are down. And what that means is that your solid stock picking strategy works better now than before. Correlations, by the way, are also down because the hedge fund activity is down, and we spoke about this a second ago. That means that ETF activity has been on the decline since the beginning of the year, and that lowers correlations as well as earnings season. But so you can pick your sectors, and you've seen some sector rotation. And 2011 was not that great for asset managers, and this rally in the market has really spooked some people in saying, okay, I can't underperform a second year in a row. I'm going to have to go with where the money's going. And if that's the beta, that's fine. But for those that want to stay a little more conservative and not kind of swing for the fences, there is still risks out there.
Oh, it's very true. Diana, great to see you again. Thanks for your time this morning.
Thank you.
Diana Avigdor, VP and Head of Trading at Barometer Capital.
When we come back, we'll take a look at the market. Some interesting movers right at the open. We're going to dig into some of them. Nevsun Resources, in fact, that's a big mover to the downside. We'll give you those details when we come back.
With iShares